All right, let's talk a little bit more about the state of the U.S. economy after that big move yesterday. Sarah House, Wells Fargo senior economist, joins us now live along with Emily Roland, John Hancock Investment Management co-chief investment strategist. Great to have both of you on the program this morning. Why don't I start off with you, Emily? You had a note after the meeting yesterday noting that we could be in a late cycle environment here, which translation might be we're about to reach the end here, and that recession we were just talking about might be happening. What do you think of the Fed's messaging that they can avoid that Jay Powell hopes we don't have to get into the R word?
Yeah, he certainly indicated that they hope that we're not heading for a recession, but hope is not exactly the best investment strategy out there. So we do think it's important that we position portfolios for these late cycle dynamics, which essentially means growth is slowing, inflationary pressures are persisting. The Fed is clearly hiking aggressively into that until they stop and start cutting, which we think will happen in 2023. So we need to prepare portfolios. There are parts of the market that are starting to reprice for a recession, and that might sound obvious, but clearly the bear market that we're seeing play out in equities, which is continuing today. We've seen a massive, reset in certain sectors of the market. But the bond market is the one place that has not really repriced for a recession. Yields remaining well over 3% here. They continue to climb higher based on this increasingly hawkish message from the Federal Reserve. But normally in a recession, and listening to your show today, it sounds like most people are moving in that direction, bond yields actually fall. And so we expect there to be a bid for treasuries once we see yields peaking out here, once we see inflationary pressures start to subside. And we think we'll see a bid for higher quality, low default type assets as investors start to prepare for a recession. So we look opportunistically at bonds today.
Sarah, you could certainly argue that yesterday's hike by 75 basis points, certainly an admission by the Fed that they are, in fact, behind the ball here. You said that it will take a more material slowdown to bring core inflation back to the Fed's 2% target. What does that slowdown look like? What will it take to rein in inflation back to that 2%?
So we're expecting the U.S. economy to slip into a recession in the middle of next year. And so we do think that it's going to take that actual contraction in growth. Unfortunately, some job losses to where the unemployment rate starts to rise, relieving some pressures on wages to help bring inflation down, in addition to just some good luck in terms of things like supply chain easing and perhaps some relief on energy prices if you get at least some stabilization in the situation with Ukraine. So I think it's going to take both a reduction in demand and then some good luck on the supply side as well.
Sarah, as a follow-up to that, the bigger picture question here, I guess, is what does 75 basis points do that's dramatically different than a 50 basis point hike yesterday on addressing those factors that you just described?
So I think it sends an important signal that the Fed is trying to be nimble, that they are reacting to the data. So yes, a lot of the upside surprise in the CPI report we got last Friday for May was in energy, but it was also an upside surprise in the core, showing that those inflation pressures are more entrenched. And so I do think that the Fed's shift to that 75 basis point, while 25 basis points, and it doesn't mean much between one single meeting, but I think it's more the signal that's important, and it does show that the Fed remains on this aggressive path. And I think it does have, obviously, we've seen a reaction in markets of rethinking about how far the Fed will go and what that means for the economic outlook as a whole.
Emily, we certainly got other decisions from other central banks today. We were talking about the BOE as well as the Swiss National Bank. When you look at the broader picture, obviously all that liquidity that we saw in the market during the pandemic getting sucked out. And I wonder if you're talking to investors, where do they invest in that environment right now?
Yeah, the big challenge, Akiko, is that the cycle is moving so rapidly. And we're not used to that. We've had low inflation, low rates, low growth for a long time here until the pandemic ensued. And we got this massive response from fiscal stimulus, policymakers in Washington, from the Federal Reserve, bringing rates all the way down to zero and using forward guidance to tell us that they were going to keep them there for a long time. And that fueled this massive rally that we saw in risk assets coming off the height of the pandemic. Clearly, inflationary pressures ensued. We had the biggest mismatch between supply and demand that we will probably ever see again in our lifetimes. And now the Fed has no choice but to tackle that. So we're moving rapidly from early cycle to mid cycle. and now into late cycle, and we have upped our projections for recession from here, like Sarah has as well. So, that's the challenge. And I think there is an opportunity now for investors to make those shifts in portfolios, to look at those higher quality assets with great balance sheets, good return on equity, good earning stability, and barbell that with more defensive parts of the market as we move away from an environment in which consumers have binged on everything they've wanted. I don't know, maybe you guys can relate to me on that. More towards things that they need. So looking for your more traditional sort of defensive assets. We like areas like healthcare, infrastructure equities, which benefit from more consistent demand and income. That's really where we would focus. And then just notching up on quality within the fixed income portfolio to prepare for an environment in which volatility is the new normal.
Sarah, when we talk about the next Fed policy meeting, which is in the last week of July, a lot can happen between now and then. We'll get a new jobs report. We'll get another CPI print, another PCE print, every inflation reading you can imagine. What's the most important for the Fed heading into that next one, which could decide the difference between 50 and then 75?
No doubt it's the June CPI report that we'll get on July 13th. So we're expecting year over year inflation to hit 9%. Now, a lot of that will be driven once again by energy, but still expecting a lot of strength coming out of the core. And I think with inflation continuing to head the wrong way, it really ties the Fed's hands to where they have to go 75 again. So we think we'll see another huge increase at the July meeting.
Yeah, I believe Jay Powell described it yesterday as inflation needs to flatten before it can come down. So got to see signs of it flattening. For Sarah House, Wells Fargo senior economist, and Emily Roland, John Hancock Investment Management co-chief investment strategist. Thanks to both of you for joining us this morning. Appreciate it.